Congress made a bunch of changes in tax law, and several of these add additional complexity to saving for retirement, but potential wonderful benefits depending on your situation. And there are three in particular I want you to be aware of that allow potentially a change that gets you more money that can grow tax-free and be spent tax-free. Number one, with an employer-sponsored 401k plan, if you go into the Roth version of the 401k, which for probably more than half of people, the Roth version of the 401k in your personal situation would be better than doing a traditional 401k. What I've always had to say is that the employer match goes traditional, meaning pre-tax. So what that means is that even if you're doing Roth 401k, which means the money you're putting in is after tax, it grows tax-free, it's spent tax-free. If you're fortunate enough to work for an employer that has an employer match, the match automatically goes traditional, meaning that you've not paid tax on it, and whatever's in that and the growth it would have over the decades, everything in that is taxable, which is not the end of the world because remember, it's free money, the employer gave it to you. But now you have an option under the law that basically nobody knows about. I saw it in Barron's, and nobody but pointy-headed people like me read Barron's. You can put money in your 401k in the Roth. The employer match that normally would automatically go traditional, you have an option to elect that be additional Roth money and pay the tax on the free money the employer gave you up front. Who should look at doing this? People who are moderate income earners. If you're not earning big money, you're in likely a very low federal tax bracket, and the benefit to you of paying the tax on the free money from the employer and the employer match so that it is Roth all through your life and you spend it tax-free later in your life is such a big advantage that it's something that you should consider. Again, if you are a more modest earner, it means you're going to have to come up with the tax money, but you're likely at a very favorable tax rate, maybe 10%, paying the tax today, knowing you never have to pay tax on that money again, and over the decades how much it'll grow, that's an advantage. Now, something else I talk about a lot, SEPs. A SEP is Employer Retirement Plan for Small Business. And then there's something called the Simple, also for small business. Those were always traditional only, meaning you got an upfront tax benefit, but everything in the account was taxed later in your life. Now you have the same Roth option available for you as an employer if you want to offer a SEP or a Simple, or really you're the one who gets more benefit from those plans than anybody else. If you want to have Roth money instead of all money that will be taxable later in life, you now have that option. Now, the third thing doesn't go into effect till next year, and it solves a dilemma. You know, there's about 65% chance that a child is going to go to college. It's about 2/3, somewhere more or less. So that's always been a brake on people contributing to what are known as 529 plans. Well, starting next year, you can contribute to a 529 plan for your child, which grows tax-free and is spent tax-free for eligible college expenses. And in many states, has an additional benefit, a tax deduction on state taxes. So you get something as great with a 529 as you do with an HSA, which I've always said is the greatest savings plan there is, because you get an upfront deduction and then you get tax-free growth, tax-free spending. Well, now a 529, which has many of those same characteristics, if your kid is one of the 1 in 3, let's say, who doesn't go to college, you're able to convert that starting next year into a Roth IRA for them. So it is never taxed. And you know how I'll tell people, you can't do a Roth for a kid till they're working. Well, now it means you can basically do a Roth in a backdoor way starting at the time of a kid's birth. Can you imagine how much the money would be worth down the road? It's capped at $35,000 that you can do this with under the law starting next year. But what an incredible deal to be able to put that money in, have it be used for education, or have it be used for a retirement account. Both strategies end up working in that one 529 account.